Welcome to Benzinga's virtual event. Something that we love to do here is to make sure that we make all things finance very easy and simple for you and I and everyone else involved to understand. And today we're going to be doing just that. And that's going to be with our real estate Reimagined, because we want you, the viewer at home, to capitalize on unique opportunities in a changing market. Interest rates are going up. Interest rates might be coming down, but the prices of homes have been fluctuating a little bit as well. And do you have to personally own a property physically to be involved in the real estate market? That's what we're here to discuss. And my main man, Kevin, is going to go ahead and kick things off for us. Kevin, what's going on?
Hey, thank you. I'm really excited about the opportunities we're looking at right now. I think any time is a good time to buy real estate. That's what I do. But, I think now in particular, we're looking at some, extraordinary opportunities. And, the most exciting thing about it is there are options available to, just the everyday investor that, haven't always been available. So,
I mean, I always thought, and I grew up thinking that, hey, you had to have a certain amount of money to pay the 20%. You had to have a certain amount of luck to get the right location, and there's a certain amount of interest rate, which obviously some people got blessed with back in 2020. But I'll tell you what, man, I know you've got a great guest lined up, so I'll go ahead and see myself in the back.
Awesome. Thank you. So we're going to bring on the CEO of Vici Properties, Edward Pitoniak. There you are.
Hey,
all right.
Kevin,
Hey, Ed.
Good to see you.
Hey, you too, as always. Before we kick off, do you mind just giving the viewers kind of a rundown of, what Vici Properties is exactly?
Yeah. So as a starting point, Kevin, Vici Properties is a real estate investment trust. And with the theme of the show you have today, which is, how can your community invest in real estate? One of the key ways to invest in real estate in America, as a retail investor, for example, or as a non-institutional investor, is through real estate investment trusts. Real estate investment trusts really began to emerge in the early 90s. And it was IRS legislation that enabled real estate investment trusts to be formed and distribute their income to their investors without the imposition of any corporate income tax. Okay. So if a real estate investment trust realizes $1 of distributable profit, it can distribute that dollar with no corporate income tax imposed upon it. That dollar gets distributed to the retail investors of the REIT, or whichever investors might own the REIT, institutional and retail. And then they might pay a tax on the dividend, but it doesn't get taxed twice in the way that conventional corporate dividends do. And so through real estate investment trusts, you can own a whole bunch of different categories of properties. You can own offices like the one you're in today. You can own retail. You can own residential, like apartment buildings and single family rental homes. And as of late, you can own assets like Caesar's Palace or the Venetian or MGM Grand or Mandalay Bay, which happen to be among the assets we, Vici, own. Prior to the creation of gaming real estate investment trusts, retail investors never would have had any chance of owning a casino on Las Vegas Strip, but now you do.
Yeah, I mean, to me, investing in a REIT, it just seems like such an easier way to diversify than putting everything into one property, hoping that goes well, adding another and another. Which I think is why, I think that so many people don't get started in the real estate, even though it's hard to argue that it is such a great asset class. So, getting into the REIT, like you can, any type of property that you believe in. So, as you mentioned, like the Venetian and MGM Grand and these, iconic casino properties, you are primarily in the Las Vegas market, correct?
Almost half of our rent comes from the Las Vegas Strip. The other half comes from regional gaming properties across the U.S., from Lake Tahoe in the west all the way through Atlantic City in the east. As well, we're now collecting rent and or interest income from a variety of non-gaming operators like Valero, like Great Wolf Indoor Water Park Resorts, like Cabot, the high-end golf resort creator and operator, and Canyon Ranch.
Okay, so would you say like your focus is? It seems like more on like the experiential, properties, the things, places where people can go and do things. What is it about that? I guess particular asset class that that you find attractive, that you think is the you know best for the future of Vici?
One of the, I think one of the key elements of experiential real estate, Kevin, is that very often you leave experiential real estate with nothing in your hands, right? You haven't gone there to buy a good. You might end up buying a good. You might end up buying a T-shirt or some other memento of your trip, but you've gone there to have an experience. And that really helps reduce the obsolescence risk or the secular threat of experiential real estate versus other categories of real estate that have the risk of being literally and figuratively displaced. We saw a lot of stress in retail over the last 20 years because of the emergence of e-commerce. Suddenly, I didn't need to go to a store to buy a good. We saw it emerge recently with office. People don't necessarily need to go to an office to work, right? When something can be put in a box or shipped through a wire, the real estate it might have been historically associated with is under threat. People do not go to our assets to acquire goods that can be put in a box and or services that can be shipped through a wire. They go to our real estate to have an experience, which we think ends up constituting the long-term durability of our real estate and the lack of risk or threat from obsolescence.
Okay, so I mean, we're I guess facing like kind of an uncertain economic times. There's have some people are saying that economy is in great shape. Look at the market; things are good. Other people are, expecting a crash. A lot of people have said it's going to be the worst we've seen in decades. I guess regardless of where you land with that, what is this experiential real estate? So I mean, casinos, particularly the bowling. I mean, how durable is that if the economy does go south, as some are anticipating?
So when we invest in real estate, Kevin, whether it's gaming or non-gaming, we look at the real estate through four key lenses. Number one, lower than average cyclicality versus consumer discretionary at large. We'll come back to that in a moment. We don't want secular threat. We want a healthy supply-demand balance, and we want proven durability of the end user experience because that ends up constituting the durability of the real estate. When you look at gaming as an example, it has historically shown surprisingly lower cyclicality than consumer discretionary at large. An example of that came during the great financial crisis when same-store regional gaming was down only 3 to 4%. That was at a time when the revenues of the S&P 500 were down 18%, when even conventional retail and food service was down 11. Vegas did take a bit bigger hit during the GFC, but that was principally because a whole bunch of new supply came at exactly the wrong time. What we've certainly seen in Vegas over the last couple of quarters is a continuing resilience to the consumer spending in Vegas, even as other certain consumer categories have started to see a slowdown. So the proven durability, the weatherproofing of gaming is pretty well established over the last few decades.
Now, what do you see, I guess, as some of the greatest opportunity, and what are you most optimistic about right now? I mean, looking at hopefully interest rates coming down next year, the Las Vegas market in general, or other markets you're in.
Well, if we first look at it at a secular level, we're so excited, and we have been from the beginning, about the secular trend around experiences, of which we've already spoken this morning. We really see cultural and demographic factors that continue to really support the growth of the experiential economy. That's the secular level. At the specific level of Las Vegas is developing into an experiential ecosystem driven by entertainment, hospitality, leisure, recreation, professional sports. This, frankly, unlike anything else in the world. If you look at what's been going on in Vegas just the last few months, you obviously had the opening of the Sphere, which has revolutionized what a concert experience can be. You had the first F1 go off in Vegas in November, and despite all the negativity of the media going into it, by the end of it all, the racers, the fans, and Liberty Media, the owner of F1, were proclaiming it the best race of the year. We just hosted the NBA in-season tournament Final Four. We've got the Super Bowl coming up in February. We've already got the Stanley Cup champion Golden Knights. We've got the Raiders. We will have the A's, and everybody, including LeBron, is proclaiming that Las Vegas is the next city that ought to have an NBA franchise. So we really see the continuing growth of Las Vegas greatly benefiting our operators and the assets that they occupy for us. We think there is no city in the world that threatens the primacy of Las Vegas as an experiential ecosystem.
So, all that sounds really exciting. It sounds like it's going to be great for, like you said, with your operators and the assets you have. But is there still room for you to grow in Vegas? I mean, are there more opportunities for you to capitalize on there?
Yeah, there certainly are. Obviously, as an example, you just saw the opening of the Fontainebleau Resort just last week in Las Vegas, a magnificent new resort that we're involved in the financing of. Beyond that, what we're really getting excited with our partner MGM is the fact that MGM operates and we own virtually all of the real estate that sits within what we've come to call the sporting triangle of Las Vegas. With where the A's stadium will go, if you draw a line from there to T-Mobile Arena, where the Golden Knights play, and then from there to Allegiant, where the Raiders play, and where you saw more activity than any other major stadium on earth last year, 2022, you form a triangle. And again, MGM operates and we own virtually all the real estate within that triangle. And we see, along with MGM, a chance to continue to densify and intensify both the assets and the experiences that can take place within that triangle. So yes, there's room to grow.
All right, it's exciting. I mean, everybody loves Vegas, right? So, to see more, more coming to the city. I just can't imagine what it's going to look like in the next, 10 years. To speak about Vici a little more specifically, I just full disclosure to everybody. I mean, I own shares in Vici and bought more recently.
Proud to work for you, Kevin. Proud to work for you.
Actually, I'm the worst at timing the market. I never try. I usually buy something just before it goes down or sell it before it goes up. And I lucked out this time. I think I last re-upped the end of October, so I've seen some good growth since then. So thank you for that.
No, thank you. It's your buying that supports it.
But what thing that I noticed with Vici, it seemed to be a little more durable this year. This has been a tough year for REITs, no question about it. And everybody has taken some hits, but you haven't taken nearly the hits, I think, as some of the other companies. And the dividend is really solid. And I mean, you've seen some pretty steady growth over the past few years. And the dividend has remained attractive. Is that, I mean, how do you see yourself as a company? I mean, more as a growth or an income play, or are you think you're going to be able to continue riding that line of both?
Yeah, well, I would say both, Kevin. I think we are growth at a very reasonable price. If you look at our track record since our IPO, the compound annual growth rate of our earnings has been just under 8%. The compound annual growth rate of our dividend has been just about 8%. Our total return over the period since our IPO is around 120%. That would still be about 30 points ahead of the S&P 500 and probably 70 or 80 points ahead of the REIT index. And that total return is a function of both the price appreciation of the stock and, critically important, the dividend that we pay you. And I think as an investor, you'll always want to be very focused on the degree to which historically dividend, it represents a significant percentage of long-term total return, even for groupings of stocks like the S&P 500, where the current dividend yield is only about 1.5%. We currently offer about a 5% dividend yield. And when you look at that dividend yield together with stock appreciation, you have a shot at getting 10% total return year after year. And if your audience knows the rule of 72, they would know all you have to do is take that, what you presume to be long-term growth rate or return rate of 10%, divided into 72. That tells you how soon you'll double your money, which in that case would be 7.2 years. So I think that is the value of REITs. And exactly to your point, Kevin, the dividend gives you the opportunity to get return, even in very tough times in the market for most stocks, which the last couple of years have frankly been. Everybody thinks the S&P 500 is going to the moon. Well, it's only just getting back to where it was 2 years ago, right? If you got a dividend during that 2-year period, you at least made some money. If you had no dividend, depending on what stocks you picked, and especially if you did not pick the Magnificent Seven, you probably don't have a lot to show in terms of return for the last 2 years.
Yeah, that's one thing I always look at with dividends. I mean, look at stocks with some growth. Over years, I hold it for 10 years, and I see these gains, but I can't do anything with those gains during that 10 years. Where with the dividends, I can reinvest those. I can buy more. So that's, to me, it's a no-brainer. But
yeah, no, exactly to your point, Kevin. You walk into a store and say, "Hey, can I pay for this with the unrealized gain of my stock?" They'll say no.
Yeah, exactly.
Whereas, can I pay for this, whatever I'm buying, a nice bottle of wine, can I pay for it with my dividend income? Sure you can. Or you can reinvest the dividend income and really get the benefits of compounding.
Yeah, absolutely. So I think across the board, not just REITs, but some dividend stocks in general, have gotten beaten up this year, I think, because of interest rates. That risk-free rate is so high. As that comes back down, I mean, I'm not asking you to predict the market here, but I mean, typically, would you expect that to, have an effect on, the prices of REITs and other dividend stocks as interest rates come back down?
It absolutely should. If you want to look just across the broad lens, and then we'll get to REITs in a moment. Right now, the earnings yield, which is simply the inverse of the price earnings ratio, the earnings yield of the S&P 500 is 4%, which happens to be just about the risk-free return rate of the US 10-year Treasury, okay? Which means, like, why am I owning this stock if I could own a risk-free instrument at the same yield? Of course, the reality is, we've learned with bonds, especially the last couple of years, it isn't really risk-free because the value of the bond can vary wildly on any given day. But to your point, yes, REITs tend to benefit in a period of stable and or declining interest rates. They don't tend to do well, as they didn't generally this year and last, in a period where interest rates are rising markedly. So the decline in the risk-free rate has been beneficial for REITs, especially over the last 8 weeks or so. You bought your Vici stock in October at a very good time. And we'll see what the coming year brings. Obviously, there's a lot of debate and discussion, and frankly, a bit of confusion over what we should expect for risk-free rates in the coming year. But as long as they can at least stay somewhat stable and leave behind the wild volatility that the bond market has had this year, I think we're looking at a very good setup for 2024 for REITs generally, and Vici specifically, given the earnings growth we've already got baked into next year.
Awesome. Well, I can't wait. I think we're probably getting just about out of time here. Before I let you go, I mean, is there anything else that you want to make sure we tell our audience today while we have you?
Well, just again, to really look in terms of how you build your portfolio, where is it you're going to get, as you referred to a moment ago, Kevin, where are you going to get that current income that come hell or high water, you know will be there? It's money you can reinvest. It's money you can spend. It's return you can count on, even when stocks, the value of the stocks themselves are going up and down, and perhaps down for a long period of time. And this is, again, where REITs can be a really virtuous investment as part of the portfolio. I would never tell anybody invest only in REITs, but as a segment of your portfolio, it is a great way to build wealth over the long term. Because again, go back to that, 5 to 10% total return compounded year after year after year. And if you're younger, if you're in your 20s or 30s and you compound for 30 years, you're going to have a lot of money at the end of it.
Yeah, absolutely. Awesome. All right. Well, hey, thank you, Ed, so much for being here. I can't wait to catch up again and tell you how much better my Vici stock has done in the meantime.
All right, Kevin. Thank you.
All right. Thank you. All right. So Ed Pitoniak, Vici Property. I think up next, we've got Realbricks, I believe, a different type of real estate investment that Nate is going to be talking to.
Hey, appreciate that. By the way, I did tell Siri, remind me whenever I need real estate investments, I hit you up. So let me know when you get invested in that October type of stock next time.
All right, deal.
All right, appreciate you, and hope you guys are enjoying the conversation, because we've got another great one lined up with Kevin Cottrell, who is the CEO of Realbricks. Kevin, thank you so much for joining us. How's it going, Kevin?
My pleasure. Looking forward to the conversation today.
Absolutely. I'm really fascinated by what your company does. I got a chance to stalk you on LinkedIn as well. I mean, you've been in the real estate game for quite some time, but I'll let you tell the folks at home, what is it that your company does?
Yeah, we are a fractional real estate company. We basically take a real estate asset and create fractional interest or shares in it. Those are securities. So it allows an investor, whether they're, I'll explain what this is, an accredited or a non-accredited investor. And that tends to be the problem, right? People think about investing in real estate where they see multifamily, like apartment buildings, they see big commercial projects, development projects. And unless you have a very high net worth and high income, you can't invest in those. So Realbricks allows people to invest with a minimum of $100. They don't have to be accredited, meaning meet those standards. And you're essentially selling them a security interest in the properties.
Now, I'm glad you mentioned that, because I am a point and click type of guy. I don't know if you or the viewers at home know what RuneScape is. That's what I played when I was younger. It's how I was rewarded, which is why I love trading in the stock market. It's all linked. And I've always thought real estate was like, hey, you got to own this physical property. That's how you got to hold on to it for years, and that's how you can make money on it. But you're saying that you kind of make it easy for the common man and woman to get involved by just kind of fractional shares, nothing too crazy. You invest in it, you can hold on to it as you'd like, you can go on and sell it when you'd like as well. It's that easy.
Yeah, so if you think about it, I mean, our marketplace, which will be web-based, will launch in January. Shortly thereafter will be an app, much like Robinhood, where you can point and click and purchase. And you do exactly what you just described.
Yeah.
And, that tends to be the challenge with real estate, is people think of it as, this is a difficult process. I need to assemble a down payment. I need to know how to manage it. Then I got to think about how in the world will I sell it. Right. And in our world, we take care of all those headaches. We manage it, et cetera.
Yeah. Well, I mean, look, if there's one thing I know is that liquidity matters. When you want to get out, you got to have someone else that's going to let you go and exit your position as well. Let's talk about what type of real estate assets are exactly offered to investors as well. And I'd love to know the process. I know you said you've got a web platform coming up. I know you said Robinhood as well. You need a minimum of $100. Is there anything else that our viewers at home need to know to kind of get involved with Realbricks in this process?
Yeah, I mean, we're regulated by the Securities and Exchange Commission. So a lot of what's going on out there today, and the spilled over from the digital crypto world, is a lot of people are fearful. So we're a fully vetted and qualified entity, from the Securities and Exchange Commission. So as a qualified issuer, whenever we launch our marketplace in January, someone will know that they can open up an account. They need to go through the vetting process required by the SEC. So there's know your customer, or KYC, anti-money laundering, which is that basically they'll upload their ID, they'll verify themselves, they can securely through our partners attach and provide funds into their wallet, and
Right.
then they can then go make a purchase in a manner that will create shares that are issued to them by our broker dealer partner, and then there's actually a transfer agent. It's much like buying stock on Robinhood.
Yeah. And that again makes it easy and kind of gamified a little bit as well. I told you I stalked you on LinkedIn, so I know that you've done a lot of work, especially on the Texas border rescue and all the other great things that you've been doing. The reason I bring that up is because I mentioned that for me it's a little tough, especially as an immigrant. I sometimes feel like, hey, it's a little tough to invest in the real estate market. You clearly have a passion for real estate, but also not just that, tying that in with underserved individuals to invest. Why does that matter to you? Why does that matter to Realbricks?
It really matters to me because when I got out of college many years ago, I was lucky enough to get hired by Marcus and Millichap, which a lot of people know the name or have heard it. It's a boutique, probably the premier investment brokerage. And almost everybody there was 15 to 20 years older than me and had at least 10, 15 years of experience. They were doing real estate investments left and right. And because I didn't qualify, I was kind of really locked out of the real estate market. So not only me, but the passion from the Realbricks team is to create an entry point where anybody can purchase, starting with $100. And to your other point, we're also providing an off ramp. So we're realistic. We know if somebody invests and buys $1,000 worth of interest in a real estate asset, something comes up, they need to potentially get out of part of it or all of it. We're going to provide a secondary market on our marketplace, which will allow them to do that. We'll be really the only player with that potential off ramp for real estate.
Now, we already talked about liquidity. I don't think I asked the question of how long would I have to hold the investment for? Say I buy it on January 1st. How long do I have to wait till I sell it? Or I can sell it?
Well, so technically the first part of that question, and it's a great question, is driven by the regulations for the Securities and Exchange Commission. They want the primary shares to have been fully subscribed or sold for 30 days. And then Realbricks can then make it available by filing a form that allows it to be available for a push, if you will, if somebody wanted to sell in the secondary market. So the answer from a technical standpoint would be a minimum of 30 days. Now, the way we try and guide people, and we're going to have a tremendous amount of education and information, is real estate should be a long-term play, right? This is a little bit different than investing in stocks and the equity market. Most people, if they want to take advantage of a combination of cash flow and appreciation, will probably look to hold 5 to 7 years.
Right.
Obviously, there'll be some interesting scenarios that come up in the next few years. We expect to have some of our assets appreciate much more rapidly just because of how we expect in the upcoming market that's going to happen, provide some more upside that may allow people to do it way quicker.
So 30 days, but that's because of regulations. And of course, as soon as that's available, you'll make that available as well. You mentioned your team. Obviously, I have the pleasure of talking to you. Anyone else on the team that we should know about that's involved in the project?
Yeah, I mean, if you look at the team, unlike a lot of property tech companies, we've got a great tech team. We've got a great operations team. Our real estate bench has more than 100 years of experience, right? We've got, not only myself, I've been with almost every major brokerage since the mid 80s, and got a lot of experience, billions and billions of dollars of property sales.
Yeah.
Gene Frederick, who recently came off the board of EXP World Holdings, a publicly traded real estate brokerage firm. We've got Scott Lewis, who's been in the business. He's our chief strategy officer. On the advisory side, we've got a great bench on the advisory side. Chris Heller, for example, used to be the co-CEO of Keller Williams. For listeners here, you're going to start hearing names of the biggest and the strongest players in the market. We feel like we've assembled, in terms of core competencies, the best bench, both on the actual operations and strategy side, but also on the advisory side.
Now, when it comes to real estate, so much of the conversation, as we were about to get to the final moments of wrapping this up, has been around, interest rates and the price fluctuating, right? Like, whenever you think of something dramatic in the real estate market, you think of the Big Short, you think of 2008, and now interest rates are, kind of through the roof. And obviously there are talks of cutting it, but no matter what happens in the future, no matter what the Fed does, is your company able to, I don't want to say survive, but make sure that the investors have the tools and resources to make the best decision possible? So I know there's no guaranteed returns or none of that, right? It's an investment for a reason. But what are your thoughts on the outlook of what may happen in the markets based on interest rates and everything else that's going around?
So Realbricks is an all-cash investor. I mean, we may change at some point in a different interest rate environment where we can apply positive leverage, meaning the return is higher than the interest rate that we would borrow at, to actually apply some debt to our purchases. But for what we are launching in January and for the foreseeable future, we're all cash. So there's going to be a cash return that comes from the net income on a quarterly basis for investors. We also, because of our experience, which we just talked about, are going to take an approach to be very smart about market selection and property selection. In other words, it's not a let's just go hoover up anything and everything we can. And some of the players in the market really harm themselves by applying high leverage debt and not being very strategic about looking at where are rent levels, what's the trending on rents, what's happening in the market with everything from demographics and employment, and how strong has that market been both historically and what's the recent trend. So we feel that between some of the AI and the data feed stuff we're going to do, and then our high level of experience, we can buy right. Because here's the trick. What most people don't know, and this is kind of, I wouldn't even call it the dirty secret, but the reality of real estate, you make your money on the way in, not when you sell.
Yeah, I mean, you got to make sure you time the buying and the opening price of it as well. When it comes to investing, fractionally, the reason I like it is because you get a chance to kind of diversify your portfolio a little bit. You get to kind of have your eggs in many, many different baskets. Can I kind of choose in terms of like, hey, I feel like this type of property, whether it's commercial real estate, whether it's residential, whether it's certain cities that I feel like might be, like we had a great guest earlier talking about Las Vegas. So either now or in the future, am I able to kind of see which type of fund or where I want my investments to go to, or is it one big pool?
It's their individual properties. We may have a fund that is a portfolio fund later. We're certainly discussing that, and if it makes sense, we may roll that out. So you can pick the property. You'll know everything about it. You'll know what market it is. You'll see our data and our information on that particular property. So it allows people to, it's almost like you're getting a group of investors, right? Like those investments I was describing earlier were syndicated to buy apartment buildings and things like that. This is essentially buying a slice or a share in a property that's 123 Main Street. You may decide we have a property, for example, if you like it and you're in Las Vegas, great. If it's in Orlando, great. Maybe you say, I really like this part of the country. What do you have over there? Yeah. And we intend to socialize through our blog, our social media, information and intel about why we think certain markets and property categories are where things make sense, and share a lot of our wisdom so that investors who typically tend to be less experienced can get some guidance. This is almost like what I got from those more experienced brokers. I knew what I wanted to buy, right? I was sitting there at Marcus Millichap, and they would tell me, this is why we buy these. This is how we analyze the market. And then I was locked out. The difference in Realbricks is we're going to share that same kind of wisdom and guidance, but you're not locked out. You can actually come in and buy at a minimum of $100.
All right. Well, I mean, I've been saying it from the beginning. I love the fact that you only need $100 to go in and get invest. I like the fact that you can get out in 30 days because the old school mindset of mine was, oh man, I don't want my money stuck for 4 years. And if I want to sell, I got to find a buyer. Obviously, you're helping provide the secondary market. You're helping provide the liquidity aspect of things as well. But before I let you go, Kevin, I want to turn the floor over to you. Is there anything else that you wanted to talk about? Anything else you want to discuss that I didn't bring up? Our viewers are listening.
I can tell you that one of the most frequent questions we get, right, because you see a lot of this going on with crowdfunding being so popular now, is Realbricks going to do something in the form of crowdfunding? I mean, we're certainly considering it. We're having some discussions internally. And so the second part of the question, I got this on email yesterday, is if you guys do a crowdfunding, how am I going to know about it, right? So for anybody listening to this, it's the same step to start, right? You're not obligating yourself. You can go to realbricks.com, set up an account, go through the process, make sure you're all set up, and then that's going to put you in the queue to be notified when the marketplace goes live to learn about properties. And if in the future we launch a crowdfunding investment opportunity in the actual company Realbricks, you'll be notified there of both of those opportunities.
I love it. And when I'm on your homepage right now, and it says, you have your spiel. It's like select a property, buy shares with as little as $10, depending on the property. But you can grow your portfolio one brick at a time. I love that. Way to have it all come back together in terms of what you're doing
Yes,
and what
sir.
your company's doing. But Kevin, excuse me. Kevin, it's been a real pleasure talking to you, man. Love what you guys are doing for, the little guy, gal out there to invest in the real estate market. And I look forward to more conversations, especially when you launch the app. I look forward to dabbling a little bit in myself.
Absolutely. Thank you for letting me come on today.
Absolutely. Sorry, folks. But that is Kevin Cottrell, who is the CEO of Realbricks. And again, we'll continue the conversation because we want to always make sure that we are changing the ways that you can go ahead and invest in the real estate, because it's not just like, hey, you have to go to a broker. You got to go ahead and get, certain finances and things like that taken care of. I'm going to go ahead and kind of continue the conversation here with another interview that we've got lined up. And that's going to be with John Green, who is the CEO of Nada. Let's go ahead and get John up on the screen. John, how's it going? You're muted, and it's totally okay because I did that to start off the show, buddy. It happens to all of us.
Well, I think you guys have an auto mute, so everyone has to stumble into the interview, man. Doing well, man. Thanks for having us.
Absolutely. I'm really excited to talk about real estate, especially because, all the companies that we've got here today, they're all doing things a little bit different than what may be conventional. But let's go ahead and tell the viewers at home, though, what is it that your company does, especially when it comes to the real estate market?
Yeah, absolutely. So Nada is a residential real estate investment platform. We've created the first series of real estate funds that allow for individuals to invest in single-family home equity as an asset class. We do this through our key investment products, which we call city funds. And these are city-specific portfolios of these home equity assets that allow for an individual to select a specific city to gain exposure to, again, that residential home equity market. So we have, for example, we have Austin City Fund, Miami City Fund, Denver City Fund. And so, et cetera. Anyone can go pick that city and go big on it.
Yeah, that was what my question was to Kevin earlier about how, for example, we talked about Vegas with Vici properties earlier on. It's like, hey, if my man LeBron does go ahead and invest in that, city and has an NBA team there in the future, what if I want to invest in that? Or there's been so much conversation of the new Silicon Valley being in the lovely city of Austin, Texas, even though they got rid of the graffiti wall, but that's a different conversation. So you can go ahead and figure out, hey, I believe in this city. I believe in the growth that's happening here. I can go ahead and invest in it. Now, I'll ask the same question that I've asked others. How long do I have to keep my investment? For example, if I know that, hey, I'm a seasonality investor, right? Do I have a certain time limit that I have to be invested in?
In terms of a lockup period, let me just back up and say the construct of our funds these are pooled funds, so not single investments. So you have diversification instead of single asset exposure. One, the liquidity component of the fund is there's no lockup period. They're very net asset value sensitive in how we do monthly net asset value updates, which is NAV per share. So you see this kind of incremental update. The liquidity options are twofold. One, we have a partnership with an SEC registered alternative trading system. So it's similar in the most basic functionality to that of a secondary market, like a public market. People can list and sell shares. Yeah. And then the earlier stage, more prominent is a redemption program whereby the manager, us, will repurchase shares at the most recent NAV in a quarterly basis.
I appreciate you breaking down the insight on that. I'd love some more insight on why you decided to focus each offering on like a single city itself.
Yeah, I think you kind of leading me into that, man. I mean, Vegas is one of the cities that we're going to launch soon. So, I mean, fundamentally, a city is something that people can experience. It is like a collection of people and places, and so it almost like it's something that, let's say Austin. Maybe you went to school in Austin. Maybe you're traveling to Miami. You're following the news, for example. Elon Musk is doing this or that. He's investing a lot of stuff into Austin, to your point earlier about Austin really being this big tech boom. Yeah. And so that is something that people can participate in from really wherever they're at in terms of the news and the perceived economic impact. And so what we believe is that you want to invest in what you can experience and what you can identify with. It creates a thematic relationship. And so that's the core concept is you believe that action that maybe Elon or insert here, whatever's going on, you believe in the institutional colleges there, et cetera, you can participate in that market. Messi just joined the Major League Soccer team in Miami, and they're doing this massive new stadiums. There's a lot of development. Yeah. These are things that people read about. These are economic events. And so by constructing a fund that is city specific in design, and again, unique in the asset type, that being like it's equity in a home, people can, no matter where you live, you can participate in that economic growth, that development. And lastly, I would relate it to not dissimilar to how someone would look at a publicly traded company. A city has a tremendous amount of public information. What's the population, the demographic, what are the economic changes, et cetera. So there's a great deal of information accessible for someone to really kind of do their own due diligence about, what they think of a city beyond just pop culture.
Yeah. Whenever you start to invest in the stock market, I've always told my nieces and nephews, they're like, oh, what do we invest in? It's like, well, look around you. What do you use on a daily basis? And start there. And I bring that up because you brought up how, if you went to school in Texas, go UT, or if you went to school in Houston, you kind of are a little bit emotionally attached to that, and you can do your own due diligence on that. You mentioned home equity investment. So let's talk about that. If you could tell me a little bit more about home equity investment as a new asset type that you're getting into.
Yeah. I appreciate the opportunity to do so. I think first we talk about like framing. It is a homeowner, like consumer finance product, much like a mortgage product. So what a home equity investment agreement does for a homeowner is a homeowner that has, built up equity in their home, and a ton of people have today. It provides them a debt alternative to cash out a fraction of that. And so again, to make it very, very clear, like a homeowner can get cash today in exchange for a repayment in the future of their home's future value. So they no interest rate, no monthly payments. This creates a tremendous opportunity and value for a homeowner. A bit obvious. There's no cash flow impact. There's no debt capacity impact. And in doing so, in exchange for it, it creates an agreement whereby we can do really structured downside protection in that investment. Right off the bat, we're going to take the appraised value of the home and take a 10 to 15% risk adjustment discount, to avoid market volatility and protect our investors. In a similar component, the equity interest that we're getting in exchange, or the homeowner getting the cash, it comes with an accelerated position. So if a home is appreciating at a 4% year-over-year rate, the equity investment we're placing in it is generally doing 2 to 2.5x that. That again is an exchange, an alternative to that of an interest rate. And so it has, again, downside protected with accelerated appreciation rates. The agreements themselves have a tremendous return profile for investors, because I think most people look at a rental investment. You get like some passive rental income if you were going into that, but really you're looking at the long-term equity buildup in that investment and trying to not lose your ass on your rental income. So this is going direct to that. Now, a key added thing is that the majority of these homes are owner-occupied homes. So from a fund manager and just really efficiency standpoint, these are effectively self-managed homes. The owner retains equity upside. There's a same covenant agreement in terms of like what the responsibilities are, et cetera. And another thing that's really critical to talk about with this instrument is these are structured so similar to that of a mortgage, like a HELOC, in that they are lien secured interest into the home, which are collateralized by a deed. So they have a very similar security profile, again, of a mortgage, publicly recorded, et cetera, et cetera. What's been fascinating to see, these products have been around for a few years, I would say a bit esoteric for a long time. Over the past 2 years, what we've seen is nearly $2 billion of institutional capital going into these via securitizations. More recently, just this year, there's been 2 rated securitizations by DBRS Morningstar, a rating agency. Macro, you look at that signal as that is really when an asset is in that emerging state. Maybe it's becoming less esoteric, much more mainstream, similar to how mortgage-backed securities are traded and how that market is stabilized. So it's a very much a growing asset type, tons of interest from institutions. And that's why, our mission and our pride is to create more accessibility to where individuals can participate in this new asset class.
I'm excited. I'm actually, while you were, mentioning different cities and the way that a structure works, I'm on your website checking it out. So you've got Miami, Dallas, Tampa, Austin, Los Angeles, Denver, Phoenix, Nashville, and I know you got more upcoming ones here that I'm not going to go to continue reading, but I'm really excited about the offering itself. But let's kind of talk about, I want to say the elephant in the room, but the elephant in the world in terms of the economics of the interest rates. Whether it goes up, down, whether we cut, what are your thoughts on that? And how do you see it impacting business for you looking at 2024 and what the Fed may or may not do?
Yeah, I mean, we're all along for the ride there, right? Take current environment where rates are up, even though we didn't see a hike most recently. Maybe a bit of an obvious point, but I'll make it. From a supply standpoint, from a homeowner side of it, homeowners today are not wanting to get out of their 4 to 5% interest rates in order to liquidate any of this, unprecedented equity that they built up in homes. So it creates we have an overflow of demand from that side in the current state. Yeah. There's always a housing supply issue, really kind of no matter what the rate environment is. And so when less people in a high rate market are looking to move, there's still people that need to buy homes. So you still have a simple supply demand issue. Now let's spin this forward. Let's presume rates do start coming back down to maybe a bit of a normalized state. In the event that there's more velocity in people buying and selling homes, that's a good environment. It's also going to prop up home values.
Yeah.
For our fund, kind of tying this all back in, we manage evergreen funds. And so whenever a payoff of a home equity investment in a home occurs, it's commonly when they're selling their home or refinancing a mortgage. So in either case, lower rate market increases home sales and increases probability of someone doing a refinance, either a rate term or cash out on their mortgage. And this is going to create liquidity for the fund. So the homeowner pays it off. The gains on the investment would be distributed. It's a REIT structure. So gains are distributed to our investors, and then the principal is immediately redeployed into new investments. So we actually increase the velocity of assets. So for us, we're really designed to operate well in any kind of market. There's just going to be different times of really you're in a really buy heavy versus kind of this higher turnover rate.
Now you mentioned investing in the cities, and we've obviously been talking about that. So let's make it very simple. Who can invest in a city fund? And almost as important, how can they do that?
Yeah, it's a good question. So we again, one of our core missions is to increase accessibility. I think there's been quite a few platforms that you guys have helped support and get this out there that want to increase accessibility. So we've gone through the SEC's qualification under Regulation A. And what that does, it allows for individual investors to participate in our funds, whether they are accredited or not. We like to focus on presenting our products less on access and low dollar points and more on the value of the investment. We believe that should be the way people view it.
Yeah.
But this opens our markets up to, again, anyone that, whether you're accredited or not, you can participate in our offerings. We do have some specialty offerings that are accredited only. There's a very clearly marked and separate, but the majority of the cities are available to anyone. So anyone interested in getting involved in the funds can go to our website or download our app. Our website is nada.co, NADA.co. And our app is City Funds by Nada. Really quick way to get in, get involved, learn more, and start building their equity position in the city.
Look, I'm fascinated by the UI that you have, and like I said, I'm on your website. I've been checking it out as well. But before I let you go, anything that you wanted to discuss, anything that you were hoping I'd bring up that I didn't get a chance to? I mean, we've got folks listening to you, man. The floor is yours.
Yeah, I appreciate that. I say first off, we appreciate the partnership with you guys at Benzinga. We were fascinated to learn that we won you guys' award this year and best alternative investment platform. We've just been qualified and getting this thing going for a couple of years now. So we appreciate you guys and appreciate everyone in the audience that's paying attention to Benzinga. I think it's a great environment, an opportunity to be a part of. I would say just more broadly, to the audience here, those that are looking to get exposure to real estate, there's historically been, majority commercial real estate, which has had a certain impact that we all may know coming out of COVID, and the growth in work from home, the emergence of e-commerce. These have had an impact there. So it's a bit nuanced with that. And the other is, there's the single family rental market. I think a great company that you guys have worked with, Arrived, has done really well there. But to really think about diversifying your exposure to real estate, such as institutions, And I just invite anyone to really, educate themselves on home equity as an investment product, because we think it has a tremendous opportunity in terms of the, steady up and to the right.
Absolutely. I think it's very important to have, we've been saying it this whole webinar long about how having the little guy and gal, making sure that, hey, they can have some skin in the game in the real estate market and kind of get themselves starting to invest, right? I mean, we've all heard it's like, hey, start with $50 a month. If you can't do that every 2 months, whatever the case may be, let's get yourself involved. Let's diversify your portfolio and kind of get things going. But man, John, it's been an absolute pleasure. Thank you so much. I'm going to grow my hair out and then I'll come ask you for your hair routine. Love what you got going on there. But for now, real estate it is. But thank you so much for joining us. That is John Green, CEO of City Funds by Nada.co.
Awesome. Thanks for having me.
Absolutely, man. We'll talk to you later and we will continue the conversation as well. And I truly mean it. Look, check out the websites that we've been, check out the companies that we've continued to bring on. We've still got a couple more left as well. Do your due diligence. But I think it's absolutely important, me personally, to kind of get your skin in the game, right? Start to have a little bit involvement in the real estate market and get your feet wet as well. But let me go ahead and bring my man Kevin back in. What's up? Did your investments go up in the last 20 minutes? Or what?
Oh, no, I'm too afraid to check.
All right, buddy. It's all you.
All right. Thank you. All right. So next up, we have Whitestone REITs. We've got another publicly traded company here. So we're going to bring on Dave to talk to us about that. Dave, there you are. Hey, welcome. And thanks for taking the time to talk with us and our audience today. I'll try to, give the overview of Whitestone, but I'll let you do that for us if you don't mind.
Sounds great. Well, first of all, just very much appreciate being able to participate with you guys today, and it's a pleasure to be with you. I'll give a couple minutes on Whitestone, and then love to dig in where you'd like to. Awesome. I think the title of your session is Changing Market and Unique Opportunities. I'd like to believe that Whitestone is a great opportunity, and we participate in the retail market. As you know, the headlines today often lump all commercial real estate together. Very simple point, but all real estate is not the same. And then all retail real estate is not the same as well. The retail sector was kind of pronounced dead years ago with the brick and mortar sector, with the emergence of online commerce, as well as kind of the death of the mall and the big box. But today is a very different environment. Your average retail center today looks very different than it did 10 years ago. So what Whitestone does is we are very active managers of neighborhood shopping centers in the Sun Belt. So we're very targeted, focused on 5 of the 7 fastest growing markets in the U.S. We look for centers that are embedded in neighborhoods, and then we try to be a great neighbor. It's a very active business. We're a bit more active maybe than some of our larger peers because we're more focused, but it's very important putting together that tenant mix and knowing the surrounding community. So a bit of our thesis is very active management. One thing that maybe differentiates Whitestone a bit from the others is our sector has really gone all in on on grocery anchored shopping centers. Whitestone is a bit agnostic in that area. We see the value in centers that maybe don't have a grocer. We think there's some risk in grocers that aren't priced in today. And we believe that our centers can outperform a traditional grocery anchored center.
All right. So, you're talking about the Sun Belt markets you're in, what is, I guess 2 questions, what is so appealing about, these markets, and 2, have these markets kind of always been your focus, or is it's kind of areas that you've transitioned to in recent years?
Yeah. Good question. So geography is a big part of what we do. I mean, if you've seen obviously the trends in the country, you've had a significant population and job migration to the Sun Belt. We're in the large MSAs in those markets. You also see the shopping center changing to be more of a place where people like to gather and do events. So in the Sun Belt, we typically have more outdoor areas, patios, gathering areas. Our largest tenant sector is restaurants, and we continue to see restaurants doing very well. So, the Sun Belt tends to be, you've had population, job growth, tends to be a little bit less restrictive on the ability of the landlord to do things, to be able to re-tenant centers. And then we continue to see more startup businesses in our markets than any markets in the country.
Hey, so with these like the restaurant anchored centers, what other type of tenants do you typically see in these properties?
Yeah, so as I said, the retail shopping center is very different today than it was years ago. Years ago, you saw many REITs in our space succeed by filling up centers with big box hard goods and soft goods retailers, signing long-term leases with those tenants that had fairly flat rate structures. And really in a more static world with low inflation and low interest rates, they had some success. That pitch was, this is a real estate safety investment. And while that is true, it's not entirely true. If some of those folks, signed 15-year leases with Bed Bath & Beyond or Toys R Us and woke up 15 years later to a different world, maybe than when the lease started. So Whitestone tenant mix is crucial. We think this is very much an operating business. We do a lot of research around the community. We understand who the consumers are. We understand what the needs are. And then we look for the best in class operators to fill those needs. If you look at our tenant mix and you think about maybe a neighborhood center that's around your house, we would have great restaurants. Some of our centers have grocery components. Health and wellness continues to be a growing sector. Fitness is an incredibly important part of many people's lives. Probably should be a bigger part of my life, but continues to be a big driver of traffic. We look for businesses that meet the needs of the surrounding community, places you go to frequently. So an important component for Whitestone is we want to be not a destination retail center on the edge of town. We're embedded in your neighborhood. Where will you go to pick up a pizza? Where will you go to drop your child off for tutorial services? Where you go for your fitness? And one of the big changes we've seen in retail is those activities have become the drivers. Years ago, people went to the shopping center to go to a large department store or a grocery store. Today, people are driven by restaurants. There were a couple articles recently in the Wall Street Journal that talked about this. One talked about the size of spaces. You've continued to see footprints shrink for businesses that operate in centers. And Whitestone is always focused on smaller spaces. It's where you see tremendous demand, entertainment venues, restaurants, services, a lot of just the things you can't get online and the types of services that are needed. Whitestone really showed very well throughout the pandemic. Our operators are dedicated businesses that look to serve the community, look to provide things you can't get online. And one of the things we do is, I think I said, is we do a lot of consumer research to really find where consumers are going, where they're spending their dollars, where they're spending the time. So our big components are food, grocery and restaurant, health and wellness, fitness and medical, services, and education and entertainment.
Okay, so to start off, how old is Whitestone? How long have you guys been around?
Yeah, so we IPO'd in 2010, so a number of years. Time goes by quickly. And then I became the CEO 2 years ago. So I've been in this seat for a couple years. We've always embraced entrepreneurial businesses. We've always embraced smaller size spaces, strong geographies. But over the last 2 years, one of the things we've done is really turned it up, really been able to execute. If you look at Whitestone's results over the last couple of years, we're leading the sector in same store NOI growth, which is really the health of our properties. We've seen our overall occupancy rates increase from the high 80s to the mid 90s in a short period of time. And really our stock has performed well as well, with Whitestone's total shareholder return about 30% over that time period, really compared to the sector of minus 5% or so. So we're starting to click on all cylinders. And one of the great dynamics we're seeing in retail is limited supply. Really, I mentioned that early on retail was pronounced dead. And so you've seen very little retail construction or new development really since the financial crisis over the last 12 years. So in the markets that Whitestone's in, you've got the great combination of, population job growth combined with limited supply, which is allowing us to increase rental rates and really grow our profitability.
All right, so you actually answered, what I was going to ask you next. About, you'd said that you've kind of always believed in the smaller spaces. So I was going to ask if that's something that you had kind of transitioned to as you've seen markets change, or if that's always kind of been your thesis. And that also kind of leads us into, one of the questions we have from the audience here. What's commercial real estate going to do as we shift into a more digital world?
Yeah, great question. I think we continue to see technology being an important part of what we do. Whitestone uses lots of technology to understand the community, to really look for what tenants we should have in our centers. But one of the changes we're seeing is small businesses, startup businesses have access to traffic data. A little scary, but obviously the cell phones follow us wherever we go, and there's lots of data on, for picking a location. Yelp reviews are incredibly important for restaurants. So I think the digital world will continue to make it important for operators, for landlords to use the tools that are there. And then Whitestone does that also with the bit of a local sharpshooter targeted approach, because we're not spread out all over. We really know our communities. But I think we'll continue to see data and the digital world, driving and helping us all.
Oh yeah, that makes a lot of sense. One of the things I'm curious about with this kind of sector specifically, if we do find ourselves in a recession in the next year, which I guess there's arguments both ways whether we will or not. The tenants you have, the operators. I mean, are these how well insulated are these industries, and then how well insulated are you as the landlord?
Yeah. Whether or not we see a recession, we see, interest rates top out and start to come down. There are a number of factors that frankly we can't control. But what Whitestone does is has a business that has significant downside risk protection, in that we have a tenant base of about 1,500 tenants or businesses. Our largest concentration in one of those is 2.5%. So we have really good risk diversification. We have shorter leases, which we love, because it enables us to work with businesses that are succeeding and share in their success, and maybe those that are struggling a little bit to restructure and help them to succeed. So one of the best tests of how you work in a recession probably was during the pandemic. Whitestone was able to have industry leading kind of collection levels, minimal tenant defaults. And part of that is our tenant base tends to be a little more local and regional. And you see operators that have a larger commitment, a larger personal commitment to those businesses. They have family members employed. They rely on that, as opposed to national businesses with a local manager. So, I'm extremely optimistic about where we are. We get asked about, are you seeing weakness anywhere? And we're not. We're seeing our leasing activity being higher than it's ever been. We're seeing our ability to share in the success of the tenants by increasing rental rates higher than it's ever been. And so, a number of things that Whitestone can't control, but we feel very good about being a little bit more nimble and flexible than some of the larger peers, being targeted geographically, really identifying the best in class operators. We pride ourselves in doing a tremendous amount of research on our properties and our communities, and not just picking a tenant, but trying to pick the best tenant for a specific need. So I think I always believe, in tougher times, you need the ability to work and pull levers. Whitestone does that. Also, our lease structures tend to be simpler than some of the national lease structures where you see tenants having control over the landlord. We have a lot of ability to move levers, to re-tenant, to move people around, and continue to do well.
So, As you grow your portfolio, I mean, are you seeing better opportunities, like with acquisitions, with picking up existing properties, or are you guys, developing, properties to kind of fit your model, or what does that look like?
Yeah. So a lot of ways for Whitestone to grow. One of the things we've been able to do over the last couple years, where the transaction market has been a bit shallow, with uncertainty as to interest rates, is we've been able to do a little bit of development. So we'll add a small pad site for a Starbucks or a Dunkin' Donuts. We're able to do those at really good returns and small amounts. So we've got a growth lever in just continuing to add a small amount of leasable area on the properties we have. We also are active in the acquisition market. Retail is a space that's different from some of the other sectors. If you think about the capital that's poured into multifamily, industrial, and office over the last several years, they're in a position now where the returns on those properties and the prices on those properties are challenging, given the higher interest rates. Retail is a category where we're still able to invest with positive returns above the debt level. I think we're getting more certainty as to what's going on with interest rates. So Whitestone has positioned itself to be able to grow with buying acquisitions in our markets. And we've done a few of those over the last few years, but been a little slower, a little more internally focused, and really building up for what we believe will be an opportunity for well-capitalized companies going forward.
So, I mean, how would you kind of describe Whitestone as far as, I mean, all REITs have, some income play to it, of course, some are more growth focused. Others are heavier on the dividend. Where does Whitestone fall into that?
Yeah, I think good question. I think we fall. We have a dividend that we pay like all REITs. We pay our dividend monthly, so that's one thing that makes us a little different from a retail investor. You're able to get a check from Whitestone every month. We also have a valuation which we feel like has significant upside. As I mentioned, our shareholder returns over the last couple of years, we think that's been positive because of the actions we're taking. We've got a number of those actions ahead of us. So I think that Whitestone, think of us as a extremely targeted geographic REIT that owns really the best in class type of retail property today, and has upside in our price. And then also we believe our dividend, as we increase our profitability, we will also increase our dividends. So we expect to be able to provide a return to shareholders, both in the form of stock appreciation and a dividend that will increase as we increase our profitability.
All right. Increasing dividends. That's always good to hear. We talked a bit about, some of the markets you're in. Are there any other markets that you're kind of eyeing right now? Anything else that looks interesting that you might want to bring into the fold? Yeah.
So, it is, when you talk about markets, as you think about the cities we're in Houston and Dallas and Phoenix and Austin and San Antonio. Within those cities, there really are individual submarkets that are very different and have unique characteristics. So in the markets we're in, we're continuing to find pockets of those cities where we think there's opportunities and there's ability to grow and add scale, to leverage our infrastructure we have in those markets. There are other markets outside of the ones we're in today that we think have similar characteristics to the markets that Whitestone operates in. But right now, our near-term focus continues to be on the Texas and Arizona markets, where we see a tremendous amount of opportunity. But should an opportunity arise to enter a market, in the Sun Belt that has similar characteristics, I think we would look at that. We like to have scale. Our properties are a little smaller, so in a market, it makes sense for us to have a minimum of probably 5 or 6 properties where we can put a team of people locally that manage and spend a lot of time with our tenants. So there are other markets, but I would say right now, Whitestone feels the markets we're in have significant growth for us.
Awesome. Well, we might as well just keep going with what works, right? All right. Well, I think we're running out of time here. So before we go, is there anything else that you want to make sure that our audience knows, or you get to tell?
I think I would, first of all, just thanks again for having me. I would maybe just end with, I think I would encourage your viewers to take a look at retail again. I mean, retail has changed significantly over the last several years, benefits from changes in work from home, where you see people orbiting around their homes more often and spending times close to their home. So I'd encourage your viewers to take a look at retail, and then within retail, look at specific property types and markets. And we really think that Whitestone has a great focus and a great target right now. So as I started out, I think I said I'm extremely optimistic about the coming years in the sector we're in, and really appreciate the opportunity to be with you.
Awesome. Hey, thank you so much, Dave. This has been great. Can't wait to do it again.
All right. Thank you.
All right. Goodbye. All right. It was Whitestone REIT. Yeah, definitely, exciting opportunity there. I'll be one of the first to say that, I was really bearish on retail a couple years ago. So I'm eating my words now. But Zunaid, are you still around?
I sure am. And yeah, I think you and I both, especially, I know Dave mentioned the mall situation. I think there was a conversation I read maybe a couple of years ago where Simon Mall or whoever was thinking about making like little hubs of influencer backgrounds just to try to get more people through the door in the retail sector. So yeah, you're not alone in that thought process at all, man. But as we kind of wrap up, I want to get your final thoughts. You've been interviewing other people, so I kind of, get your final thoughts on the webinar, on the real estate market, whatever you want to talk about, man.
Yeah, I mean, I think in general, there are so many opportunities. We had to look at a few here today, all really exciting. I think, all deserve a place, in a portfolio. And obviously, plenty of others, to look at too. So I think, the biggest takeaway is, just looking at, what kind of opportunity real estate is offering right now. And obviously it's easier than ever to get involved, whether you're buying shares of a publicly traded REIT, you're buying, into an entire city fund, or, some fractional properties. It's plenty of options. So, what's your portfolio look like after today? You started adding any of these up to yet?
I really am fascinated by hey, you can just put in a couple $100 and start kind of building a portfolio, because I generally, I don't know if you've ever played, I brought this before. I don't know if you played RuneScape, I don't know if you played SimCity, but I am a very point and click type of guy with my investments, which is why I love the trading aspect of it. So yeah, if we got a couple of companies here where if I can just say, hey, here's $500 every month or whatever that may be, I want to invest in this, whatever the case is. That's why I like the lending tree back in the day, because it was very point and click. Now your money's invested. So yeah, no, I'm definitely fascinated, especially if you know that, hey, just an example, do your own due diligence, but you've got the World Cup coming up in some specific cities where matches will be played, which means some property values may go up, right? Obviously, that's just one event. There's a whole macroeconomic standpoint to take a look at as well. But I feel like those are the type of opportunities that investors at home can take advantage of. And again, do your own due diligence. But that's kind of pretty much going to do it for us, y'all. My name is Nate Suleiman. That is Kevin Vandenboss. And we want to thank our sponsors, of course, with Vici Properties, Realbricks, Nada, and Whitestone REIT. On behalf of Aaron Thomas, our producer, and everyone else that made this webinar possible, we thank you for watching and wish you happy holidays. We'll see you next year.